Asset Management Director Jake Reynolds and Head of Asset Management James Timpson are here to talk about what's happened throughout the first quarter of 2025. James, Jake, hi. Look, if I can jump straight in, busy first quarter, Trump's inauguration and subsequent tariffs, launch of DeepSeek, tech sell-off, elections in Canada and Germany and subsequent German government stimulus, spring statement, growth in the UK's halved, conflicts in Ukraine and Gaza continue. James, have you slept at all through any of this?
Yeah, well, last quarter does seem quite a long time ago, despite that long list that you just read out. I will just mention that even though it seems like a long time ago, it was actually quite a positive quarter for us. Some of our active positions really did start to pay off, such as being underweight the US, which quite heavily underperformed other markets during the quarter. All three of the funds, Cautious, Balanced and Growth, did manage to achieve positive returns. Obviously, since then, there's been quite a bit of turmoil in markets because of these tariffs, which Donald Trump announced last Wednesday. So that has caused volatility to rise quite sharply.
Jake, could you elaborate on those tariffs?
Yes, so Trump is doing exactly what he said he would, but maybe to a level the market didn't quite expect. So when those tariffs were announced last week, it sent quite a lot of shockwaves through the global economy. But the US was hardest hit, and as James alluded to, it was the biggest underperformer today. And looking at performance to Friday close, which was the 4th of April, the US had relatively underperformed. And we went back through history, and the last time that it actually underperformed to a level significantly above this was in 1973. And that was a period that was called the Nixon shock. It was a bear market in the US that was caused by the leaving of Bretton Woods. And in the run-up to that, Nixon had actually announced 10% surcharges on all imports. So, history doesn't repeat, but it does rhyme.
Thanks, Jake. And James, through all of this, the UK's been performing relatively well.
So during the quarter, the FTSE 100 went on to reach new all-time highs. It almost reached 9,000, in fact. So it's been a really positive time for UK markets. Obviously, in the last week, pretty much all markets are down because they're panicking in reaction to these tariffs. Magnificent Seven, which was already down around 16% even before we got into this quarter, that's now down around 24%. But yeah, in the last week, pretty much all markets have felt it because we simply don't know what the full impact of these tariffs is going to be yet.
So you've mentioned in the past this thing called the VIX index, which measures volatility across markets. What's that look like?
Yeah, so just yesterday, in fact, the VIX index, which tracks the implied volatility of the US equity market, that peaked above 60 for the first time since the COVID crash about 5 years ago now. So that hopefully gives you an idea of just how much volatility we're seeing at the moment. So a small bit of good news, things are a bit calmer this morning. We're actually seeing some green on the screen today after pretty much blanket red for the last 3 or 4 days. So obviously it's far too early to say whether we're over the worst of it, but at least we're seeing a bit of calmness for the time being.
Jake, all this swinging backwards and forwards reminds me of a term I've heard but don't quite understand. Market pendulum.
Oh yeah, we talked about that in December, the December seminar to look at how the US had performed. It's obviously been an incredible 10 years for the US, and actually James alluded to some of the active positions we built that have been defensive this year. So you mentioned German stimulus. The DAX has performed really well this year. We built that position last year, and then also a position in banks that we built 2023 after the Silicon Valley Bank blow up. Banks looked incredibly cheap and attractive, and that's been really defensive this year. Banks aren't normally defensive, but they've been defensive because it was up the year to date. And you think, 2000, you've got a tech bubble that blows up. Tech's untouchable for 8 years. Financials rally into a bubble, then they crash. Financials are untouchable for sort of 15 years, and tech rallies, and now tech's now wobbling, and banks are coming back, and they're looking at really attractive valuations. So, we're always trying to be ahead of that pendulum so that we can allocate capital to the right places and avoid risks as well when things become very expensive.
Thank you. And James, to close, we always talk about it, diversification. Surely something you'll be focused on over this week and into the following weeks.
Yeah, it's our favourite word, of course, and with good reason. And during at times like this, when you have got a lot of volatility in markets, that's when it really helps having a diversified portfolio. So we're going to be monitoring the situation as it continues over the coming weeks and months. Of course, with Easter just around the corner, it's a good reminder not to have all your eggs in one basket.
Very good. Okay, well, thank you both very much for your
Thanks,
time.
Leo.
James, I look forward to catching up with you at the next market update.
Thanks, Leo.
Till then, good luck with your work. Thanks for watching. If you have any questions, as ever, please do speak to your advisor or contact us. Thank you.